Hey, Happy New Year, everybody, and welcome to the inaugural episode of the Monetized Advisor. We are so excited to bring this to you from JPTD Partners, the #1 firm in the country for helping advisors maximize the sale of their wealth management, financial planning, advisory business. So much to share with you to kick off this year. I'm here with my partner and good friend for 35 years, Scott DiGiammarino.
Morning, everybody.
Deej,
Happy
it's
New Year.
exciting stuff, right? People always start off the new year here. Do you have a New Year's resolution that you typically do every year?
I just got back from 3 weeks in Australia and New Zealand. I'm trying to figure out which time zone I'm on. Oh,
Well,
gosh.
we know that when it comes to New Year's resolutions, the big three are all around diet, exercise, and money. Those are the big three that come out.
Interesting.
Every single year. Many years ago, I did a book called The 21-Day Budget Cleanse, and it was just basically all about helping people go through the financial diet detox in the first 21 days of the
Dude,
year.
I remember that. That was a bestseller.
Yeah. Let me tell you why it doesn't work. I'll tell you why the whole book doesn't work, because people have no ability in this country to delay gratification anymore.
Well, that's interesting.
Yeah. They used to call it BNPL, buy now, pay later. I call it BNBL, buy now, broke later. That's what it is. Some people buy now, broke later. But listen, we're so excited to have you all. Our firm, JPTT Partners, decided to launch this podcast and TV show this year because the last 4 or 5 years, we've had just an overwhelming amount of financial advisors at conferences, speeches, one-on-one conversations ask us questions about this whole world of what happens if I want to sell my business one day, or what happens if I want to sell part of it. And we want to bring to you this content where we do a whole number of things. This is going to range from us talking about what's going on, and we'll do a State of the Union today, to where we see multiples of businesses, to interviewing advisors who have sold their business before, to all kinds of things that you should be thinking about if you're 5 years away from selling, or you're thinking about it right here in 2026. And we plan to bring you this at least every other week right now. But over time, you'll see more and more of us. And Deej, how many conferences are we going to be at this year?
At least 6, right? That's already booked.
Yeah, Fidelity's invited us to be at their conferences. I think we're going to be at both the Future Proof conferences. We're going to be at the XYPN. We're going to be at the RTS Summit this year, and just so many other conferences that are out there, because people want to talk to us about this stuff. So expect to see us at breakouts on main stages, all over the place. So very exciting stuff. You can check out this podcast. We'll have it up at Apple, Spotify, SoundCloud, anywhere that you can get it. And of course, it'll be on our YouTube channel as well, or you can get it on the website at jptdpartners.com. That's where it's all at.
That's COM.
Yeah, .com. Many years ago, Deej, when I did radio in Atlanta, I was on a show called The Regular Guys, and that is the way that they ended it all. They always said that you can go to thereguilarguys.com. All right. So listen, what we're going to do today on the show is that we had a banner year at JPTD Partners, and our clients had a banner year themselves. We did more deals than we've ever done before. And this year in 2026, it's unbelievable how many clients we have closing here in the first quarter and second quarter in 2026. And just the pipeline of people that are talking to us, people that range from having 100 million in assets to those that have billions and billions of dollars of assets. But, as we reflect back on 2025 for a second, what do you think, Deej, might be 1 or 2 or 3 of the major trends that you saw, doing deals? Like, you're doing them every day, every week, you see stuff. What are some of the major trends that you're seeing?
Well, well, first of all, it's great to have you. I love the fact that we're actually doing this, and to our 35-year relationship from a Celsius, his cheers to you. Most people don't know that that Teddy and I worked back at American Express Financial Advisors, and I think I was a 28-year-old manager, and you were 22 years old or so out of Boston
Yeah,
College, right?
unbelievable that I graduated.
Yeah, yeah, exactly. And you and I moved down to DC together, the region there, and we took a region that was ranked what, Jenk, 173rd out of 176
That's right.
to number one in 1 year. And we maintained that top ranking for a couple of decades, if I remember correctly.
Yeah, what I think yeah, it was an amazing run.
Amazing run. And Teddy can be seen all over television and podcasts and webinars all over the world. So incredible career to you, my partner, my friend. So listen, so a couple things. Let's put some numbers behind some things. So to your point, we've been doing this for what, 5 years now?
5 years, it's insane.
Dude, it runs really quickly. And it's funny, this whole thing started because of your practice. Ted calls me one day, and what were you running, like a $2 million RA in Atlanta?
Yeah,
2
big,
million
yeah,
top line
couple
rev?
$1 billion.
Ted calls me up one day and says, Deej, you're never gonna believe this. He says, I sold my book for what, $15 million or something like that, a 7x top line revenue. And oh, by the way, I can stay as long as I want. And I'm like, there's no way.
Yeah, no way that exists.
No way that exists because I was I don't know about you guys, but I was brought up in the world of 2.5 to 3x recurring revenue, where you had to get out in 12 to 18 months. But we confirmed it with what was it, Warburg Pincus that bought you,
Yeah,
and
it was, Blue Spring Wealth Partners was the actual M&A firm, but they were owned by Warburg Pincus, who was the parent firm funding all the acquisitions.
you had to be what, like the first one ever to have a
If I
sale like
wasn't
that.
their first deal, I mean, I had to be in their first couple of deals because this was back in 2019. It's crazy. It was almost 7 years ago.
Right. So not only are you leading this and being part of this and playing Jerry Maguire, you're actually a client. It's like a hair club of America, whatever.
Yeah. Yeah, and I still got a little bit,
You
so
still got a little bit. So anyway, first of all, for those folks who've never heard us before, JPTD simply stands for John, Peter, Ted, and they call me DG because of my last name. We're not that creative in terms of
Right,
branding.
right. We got no Ringo in here. It was John, Paul, and Ringo, but we didn't do
We
that.
tried, right? And the four of us used to be executives at American Express or Ameriprise for what, 25 years each or something like that, in charge of thousands of advisors. But essentially, we're Jerry Maguire. We represent the financial advisor to this world of private equity. To Ted's point, where you can sell a piece of your business, all your business, and you can stay as long as you want. If you want to get out in 6 months, we'll figure it out. If you want to get out in 5 years, 15, 20 years, that's perfect, because these buyers, quite frankly, would prefer that you stayed forever and ever and ever. So Jekker, the last what? Let's say the last 3 years. What do you think we've done? 120 deals?
Yeah,
Something
easily
like,
100 deals.
I mean,
I
easily,
I
right?
can't imagine, and somebody challenge us today because we're saying it publicly, that your firm has done more deals than our firm.
I've been told we've done triple
Yeah,
cumulatively
so
any
I
of the
throw
deals
down
out
the
there.
gauntlet today. Somebody say they've done more deals than we've done.
What, it's funny. One of the things we're seeing, to your question, is our mark we've gone up market a lot. I think our average size client right now is in the $4 to $6 million range. Our smallest is like 1 million of revenue. Our biggest was over 100 million of revenue now. Like,
Yeah,
right?
yeah, I was gonna say, Deej, I think, what would be really interesting for people coming into this today, if I think about the real news headlines in our industry and thinking about what we saw in 2025. You said something very interesting a couple minutes ago, which is that we were always trained that if you got 2 times, maybe 3 times recurring revenue, it was a home run, and if you got one-time commission, if you had commissionable business and you got 1 times a commission, you should be a happy camper. Um, as you look back on 2025 and you think about what you might see going into 2026, I think this may be like the single biggest headline. It's kind of like America. You're going to hear affordability being the big headline. What do you what do you believe is going to happen, and where are multiples right now for advisors? Where were they in 25? Do you see a change in 2026? As you think about looking at the industry right now.
Right. So it's funny. R- Historically, since we started this, we've been seeing 4 to 7x top line revenue. Like, and that when I say top line, that's GDC, gross, gross, gross. So that's before your payout grid, that's before a platform haircut. Or the other thing you'll be hearing, some of our buyers do it based on EBITDA, which is profitability. And on EBITDA, we've been seeing, historically 8 to 16x. Over the last 12 to 15 months, we're seeing all those numbers actually creep upwards. So we've got deals recently, Teddy. I think you and I both for north of 8x, 8.25x top line revenue. So there's this war for talent. And it's not only just about the multiples, it's also about the value added services. Because all right now we have, as of yesterday, 103 buyers. And all of these buyers are either direct private equity backed aggregators or private equity backed integrators. And an integrator, by the way, guys, is like a franchise where you take on their branding, their systems, their technology. And aggregators keep doing your thing, go get them, Tiger. And then you direct private equities for our clients that are $20 million plus or above in terms of top line revenue. But they're all saying things like, if I could free you up a day, day and a half a week, what would you do with it? Deeper share wallet with existing clients, go get new clients, or God forbid, take a very well-deserved vacation and rest a little bit, because these guys are all about growth. So what they're going to do is they're going to offer you, we'll take over compliance, we'll take over bill pay, we'll take over marketing, we'll take over technology. Basically, let's get rid of all of the operational tasks that you're doing day to day, so you can actually be happier and grow, because the way the buyers make money is if you're growing. And so that's the
Right.
biggest thing we're
But
seeing
but
is
Deej, if
creativity.
I'm hearing this, I think one of the headlines I think in 2025, and I think maybe you got this as well, is people ask the questions of why and how. Like, I hear what you're saying. I could get 12 times cash flow, maybe 14 times cash flow. How how are they doing that, and why? Why are they doing that? Why is that happening now?
Because they're basically, what they're trying to do is they're trying to roll up assets. Okay. And they're going to overpay. So let's say they're paying a 6x top line revenue for your business, where you can stay as long as you want, as we talked about. But down the road, every 3 to 7 years, these buyers are actually going to have their own event. Okay. And they're going to sell for double, triple, quadruple what they originally started with. So we're seeing deals out there in the street right now where a bunch of these buyers are selling in excess of 20x EBITDA, which is double or triple what they paid for you.
Well, let's break this down for people, because I think as an advisor, this is really important what Deej is bringing up, because when you look at where the industry is today, and you all can read the trade publications, what Deej and I have seen are firms like Carson, when you look at creative planning and other big companies, when they have sold parts of their business, they have publicly stated that the EBITDA multiple was in that 20 to 24 range. Okay. And for those of you that are listening, this is why today, and I'm using the word today, you're able to get this massive forward high overpaid multiple on your business. This is what business is, guys. It's called LBO, but you're thinking about leverage buyouts. And none of these guys work all on equity. They have to take on debt as well. And they're trying to buy you at 12 times cash flow to eventually, like Deidre saying, 3, 5, 7 years later, sell that cash flow at a 20 or a 22 or a 24 times cash flow. So you all need to understand, and Scott and I do, this gravy train will not last forever. Okay. So for those of you that are listening to this and going, oh man, I'm going to grow another 10 years and then I'm going to sell my business for 6 times. Let me let you into the fine print of the story. 10 years from now, this will not exist.
Not even,
It
no
will
way.
not exist.
No way. And by the way, this is the greatest time ever to be a financial advisor.
Right.
Right? Greatest time ever. And the reason being, in terms of these multiples, to your point, is the multiples are crazy. They're double or triple if normal. Historically, and I'm not a CPA, so check with your CPA, but historically, Jenker, was it 95% of the buyout is long-term cap gains?
Yeah, on these, I would say we you and I have seen it as high as 99, but generally not lower than 95. So you're
'Cause
basically paying 20%.
yeah, you're selling goodwill, right? How long will that tax do you think that tax law will stay open forever, never, never? Who knows, right?
How long is Trump gonna stay in office?
Right, right. I mean, stock market's at an all-time high. At some point in time, we're gonna have a recession, right? Don't you think? And you and I've lived through that
Oh, there's no
before.
question about it.
And so, markets could drop 20, 30%. Here's something people don't think about. It's a small thing, and you and I've seen this a couple times. Um, um, One compliance issue. You wake up on a Monday morning, you walk in your office, you get an email, say compliance wants to talk to you. That could blow you up to the point where no one will ever touch you. Or remember we ran into that health issue with a client
Yeah.
with basically the client got bad news health wise. Again, nobody will touch you. So right now is kind of like prime time. The market is raging. It's never been better. How long it lasts, who knows? I mean, when I first met you in this thing, I thought this thing had a 2 or 3 year run max because the numbers were crazy. But right now, it's rocking and rolling.
Yeah, so this is good. I think it's a really good State of the Union message for everybody on here because the multiples are really high right now. What we've learned in here is even if you have some commission business, it doesn't materially change the multiple. But you've got to realize this won't last forever. Now, I want to get to the second headline in here, which I think is really the fascinating part because there's a lot of shit that advisors talk about at conferences about their deals and they got this X and that X, but as you and I have seen, because from these 103 buyers, we've probably seen 80 different deals and 80 different financially engineered structures. Do all deals, if I got a deal for 30 million, do all deals look the same at that 30 million?
God, no. They're all over the board. By the way, I think we're seeing 20 deals a week right now, right? So we have a really good sense of what the market is. We have a really good sense of how creative people are getting, but all deals are structured differently. Dude, I'll tell you, one of the things that breaks my heart, and you and I have been doing this, have been in this industry 40 years. We've been advisors, we've been leaders, we've been executives. One of the things that breaks my heart is when someone calls me up and says, "Oh, I just sold to blah blah blah," and I'm like, "Okay." I said, "What did you get?" And they tell me the numbers, and then my next question is, "Well, how was that deal structured?" And then
Right.
they tell me, and I'm like, "Oh God, bro." I said, "Let me guess. You represented yourself."
So so I think would be really interesting here is as we look at the balloon, let's just give advisors some real highlights to make this simple for you from what Deej and I have learned the last 5 years of especially seeing deals in 2025. First of all, for everybody on here, a simple way to think about what you're selling, which in the end, even if people tell you they sell on revenue, everybody sells on cash flow. And Deej mentioned that word EBITDA. But we're going to take it one step further here and call it adjusted EBITDA because the way a deal will come out is your gross revenue minus post transaction comp, which is really important in a deal, right, Deej? Because one deal where somebody gets 20 million, they could be paid 15% ongoing comp. There could be another deal at 20 million where someone get paid 30% on ongoing comp, and it feels like it's the same deal, but it's a very different deal. True?
Absolutely. And by the way, let's be really even more crystal clear, Jenker. So, first of all, what is revenue? It's not revenue; it's GDC in most cases, right? So what GDC is your true gross. And I mentioned it earlier. So they take your usually you take your gross, subtract off platform fees. Then I'm getting a 90% payout where I am right now. That's revenue. Our deals are all based on growth. So those multiples we talked about earlier, those 4 to 7x, 4 to 8x top line, or 8 to 16x EBITDA, are all based on gross GDC. We call it gross, gross, gross. Then to your point, guys, subtract off your true fixed expenses, staff, marketing, technology, etc. We don't want to we don't want to see kids' cell phone bills in there or your place in Bermuda in there. We're not the IRS, so don't worry about it. But we want to true that up. And then to your point, you take 22, 25, 30% to pay of gross revenue to pay someone to run the business, preferably you. That's how you get to EBITDA. Our staff will actually work with you in actually creating those P&Ls or recreating those P&Ls, but that's how you get to EBITDA, which goes back to that 8 to 16, 8 to 18x on the EBITDA multiples.
But so the general model that most people should be thinking about is my gross revenue. By the way, we won't name names on here, but there's one firm, shockingly, Deej, that charges their advisors somewhere between 16 to 20 basis points for a global administrative fee that the advisors never see. I won't name names. I won't name names, but I will say it's so egregious, and the advisors don't understand that you can add that 16 to 20 basis points back into your gross when you really sell your business.
So that particular firm you're talking about, which again will not name names, I had a $2 million revenue client. They didn't realize they were paying $600,000
Yikes.
back to the firm, and we started digging into it. They're like, "You got to be kidding me!" By the way, that's $600,000 difference on top line revenue, right? That they didn't know about. What 600 was, it was a 3 times 6 because it's the multiple we got them.
Yeah, 3.6 million more money.
$3.6 million. Let me give you 3.6 million
Yeah.
reasons why you should understand what that fee is.
So for everybody, let's think about this again. You're looking at this, you may be thinking about it this year or a year or 2 years from now. Think about gross revenue minus post-transaction comp, and you really need to think through this because it's like if you have junior advisors or other key associate advisors, how's that comp structure going to work? Like, what do you all really need to get paid to live? Minus what Deej mentioned, which is your OpEx, the operating expenses in the business. So if you try to declutter this, gross revenue minus post-transaction comp minus OpEx, that will get you to that word of adjusted EBITDA, or what the buyer is really going to buy for your sellable cash flow. Is that
Right,
fair?
and that's fair. But hey, Jenko, one thing that's important for everybody, just a quick math equation for yourselves, is you're doing the math yourself. Right? What do you think is a good benchmark number in the industry and how PE firms look at you in terms of what your true expenses are to you, besides paying yourself, to your gross? It's usually like what, 30, 35%. So we've had clients come in saying, showing me their numbers, and they're like, have way too much expenses. I had one client at 58% of their true fixed expenses before they made a dime, um, and nobody would touch them because they're not running the business effectively. On the flip side, you get people saying, "I run this thing lean. I do.
Yeah. Right. I'm in my parents' basement still.
I got like 8 to 10% of expenses." Now that's cool as long as one thing is happening, and what that one thing is that you're growing. Okay. So if you're growing double digits, 10, 15, 20% a year, and you're running it lean, that's great. But on the flip side, it could be held against you. So if you're running it lean and you're not growing per se, again, you may be untouchable. People may not be interested in you, or you may not get the higher multiple because they're saying it's a lifestyle business. And the only reason in the world these buyers are interested in you is if you're growing. They're not interested in a lifestyle practice.
Yeah, I think it's a very, very good point. It's also why a lot of advisors that may be listening, if you write 500,000 of gross and you hear that somebody might pay you 2 million for the business, you're not going to make the 300 or 350 that you're making now in terms of cash flow in the business, right? And that's why you've got to look at this post-transaction comp. But I wanted to tee it up this way because I wanted to give one headline in here, Deej, of like where we're seeing multiples in the industry, and then two, the headline of like, do you really understand when people are talking bullshit at the bar at these conferences about what you're actually selling? It's always adjusted EBITDA is what's actually getting sold at the end of, and whenever it says I'm selling on gross revenue, I got 6 times this, 8 times that. But I want to talk about the balloon. And what I mean by that is that when you hear people at these conferences, and you're going to hear it, it's going to be big this year, talking about what they got or how they got. Deej, what nobody talks about in a deal is what I would underscore as the time value of money. What I mean by that is two things. One is how much do I take in stock versus what do I take in cash? And then number two, how long does it take me to get my cash? Because you and I have seen deals where all the cash gets paid out within 12 months. We've seen deals where the cash could get paid out over 4 or 5 years, and those two, if the prices were the same, are very different deals.
So let's talk about that. So tell you what, why don't we tee up a typical deal? So I'm on the verge of closing one like yesterday. Um, it's 40 million bucks all in,
Nice.
right? Yeah, I thought you'd be
Yeah,
happy.
I wanna be invited to that advisor's party.
Like I said, it's great to be a financial advisor right now. So we're closing a $40 million deal. Typically, they're going to get, let's call it 70% of that upfront. So what's Teddy? I'm terrible at math. I went to Babson. I don't know
For
anything.
it's about 40 million is about 28 million at close.
Okay, so Jenker, here's $28 million up front. How much of this in cash, by the way, but how much of this would you like in our stock?
How
5%.
do I know that? Because I think it's a big headline in here for 2026. Because I heard it more than I ever did in 2025. Let's just sidebar in this for a second, Deej. How does somebody even remotely try to analyze whether the stock in that company is good stock or it's bad stock?
It is really hard. Even we don't know, right?
I mean, Deej,
Because
how does everybody triple over the next 5 years? If you have 100 horses and they all say the same shit, which they all do, which is our stock's unbelievable. We're going to triple in the next
oh,
5 years.
dude, we heard it the other day. We're the next unicorn. I had a buyer the other day get on the phone with someone who goes, "We're the only firm in the industry that's doing 30% a year on our stock," and I'm cracking up. I'm like, I'm laughing on Zoom. He's like, "Why are you laughing?" I said, "Dude," I said, I can't tell you because I got the client here." He goes, "Just tell me right now." And I said, "You're my sixth Zoom
Uh,
call today, and everybody said exactly what you said.
You're
We're
the
the
only one on
only
this
firm."
call that said you're going to grow by 30%. Every other
Right. And
call,
so,
they said they're going to grow by 30%.
but what you just said is exactly what happens because what the buyers don't understand is that the clients, our advisors call us after says, "Which horse do I bet on?" Right? Because you just don't know. And so that's where the advisor has to do due diligence. So let's look at the records. Let's talk to other advisors. Let's do a home office visit, because the advisor has to be our clients have to be 150% convinced, with our help, that it's the right horse to bet on. But there's no guarantees in the stock, right? And so that's what you're rolling your dice on. Now, if you like you didn't you like you took a chunk of it in stock, didn't you, when you did your deal?
I give all the credit in the world to Blue Spring and to Warburg Pincus because their stock with the dividends, so it wasn't just stock price because they paid out dividends as well. In 5 years, $1 million went to $3.7 million.
Dude, your total economic package, when you include not the comp, but the consideration plus the stock appreciation, what was the multiple net on net on net?
I don't even know. I never went back and did it.
It's got to be a
I mean,
10x.
here's what I know. I'm rich, but I mean that's
Oh, you're funny. But look, let's go back to the $40 million example. So Teddy, his 28 million bucks. How much of it do you want in stock? They usually do a minimum of 5%, a max I've seen of 40%, right? Um, Most firms would rather pay you stock versus cash, but it's something that's we negotiate, right? And again, we mentioned earlier, vast majority of it, long-term cap gains, talk to your CPA. Then there's a series of earnouts. So now we're $12 million short of the 40. So what an earnout usually is based on two things. The first is revenue retention. So if you're a
Mhm.
$5 million producer today, gross, and you're still at 5 million, say what, 1 or 2 years from now, they're going to pay you another 6 million bucks. And that could be cash. That could be a combination of cash and stock, depending on the buyer. So revenue retention is important. They're buying 5 million. They need to make sure you maintain 5 million. And the last 6 million usually comes from this thing called CAGR, compound annual growth rate. And this is usually again on top line revenue versus EBITDA. And the target is they want you to grow 10% a year historically. Some firms will do 15, some firms will do 5. We usually try to negotiate it down. Some firms include market, some firms don't. But let's say they just want you to grow 10%. And if you grow 10% each year for like say 3 or 4 years, They're going to give you the last 6 million. By the way, one of the things that a lot of advisors make the mistake of doing themselves is they sometimes they negotiate an all or nothing deal. If you don't hit 10%, you're hosed. And then and what we negotiate is a pro rata. So if you're at 90, if you grow 9%, you get 90% of that 6 million. But we also try to negotiate as a mulligan year. This is super important because if for some reason the market goes bad, you lose a big client, it could really hurt your growth number. And so having that mulligan year or 2 years that we can negotiate in sometimes will allow you another chance of getting to that 6 million. So what we just talked about, the upfront money, cash and stock, plus the earnouts is called consideration. That's what they're buying your practice for. So when we talk about the multiples of 4 to 7x, 4 to 8x top line or 8 to 16x EBITDA, that's it. Right. And then there's comp and retirement, which we can talk about in a second. But that, Teddy, that's
Yeah.
the
So
balloon.
I think this is important for advisors again, because we're kicking off this year. You're all going to be in little group sessions that you may be doing, sharing ideas with 10, 12, 15 other advisors. You might have hired a growth coach. You're going to be at conferences and hearing all kinds of breakouts. But I guarantee you that you're going to be somewhere this year and somebody will have sold and said, "Oh, I got $30 million." And somebody will say, "I got $35 million." Well, the truth is a $30 million deal could be better than a $35 million deal, because that $30 million deal, if it all got paid out in 1 year, right? You have the money in your pocket. It could be better than a deal that pays out over 4 years that requires you to grow by 15%.
So those earnouts we've seen as short as 12 months, to your point.
Right.
I got an offer the other day for 7 years.
Yeah.
And I said, "Bro, what are you smoking?" I said, I'm sure you're borrowing money from someplace to buy the advisor, and 7 years is helping your debt service. But for the advisor, it's a terrible deal. So one of the trends that we talked about earlier, Teddy, that we're both seeing in the industry right now is the earnout times are getting shorter and shorter and shorter. So when we first started this 5 years ago, I think our typical earnout was over 5 years. Now, to your point, we're seeing this thing paid out 12 to 18 months.
Yeah.
So the more money you have in your pocket today, right? You stick in the bank, you're gonna get, or you invested, you get 8 to 10%. It is so much better off going back to the velocity of money now. And that's all negotiable that we do for you.
Yeah, let's touch on two final things in here in this State of the Union, because this is really good stuff. What do you think from what you've seen in 2025 and now going into 2026? And you mentioned this in the very beginning of our show today in talking about the difference between an integrator and an aggregator. Do you think that the industry is headed that everybody's going to become an integrator? Or do you still think there will be pure aggregators out there?
So
What do you
let's define what those both look like first. So an integrator runs it like a franchise. So essentially, you'll take on their brand. You'll become Janker Incorporated,
So
right?
that's somebody like Mercer in our industry, right? Like
Yeah,
Mercer's an
Carson is
integrator. Like you're not going to go to Mercer and not carry them. Not that it's a bad thing; they're a great firm, but you got to carry the Mercer name,
correct. So is another quintessential
right?
integrator. And most integrators typically, guys, will say to you, "Okay, I want you to look like us, sound like us, act like us," and they have a system. It's like working from McDonald's or any other
What does that
franchise
mean?
out
Does
there.
that mean I got to take over their CRM system? I've got to do money management the way that they do money management? Is that
So great point. Yes. So hey, we use Salesforce. You're going to have to use Salesforce. This is our technology. You have to use our technology. This is how we market. You have to use how they market. By the way, usually the things that they're offering you an integrator are best in class. They're superb. Okay. And but to your point about money management, one of the trends we're seeing historically, integrators say you must you must use our models. You must use our portfolio managers. One of the things we're starting to see out there right now is some of the integrators are coming off that a little bit.
Right. That's what I
So
was
right,
saying. That used to not be that way, but the trend is now they're like, listen, we're hell bent on the tech stack. but we're not bent that, if you do, your own models, that you have to use our models.
Correct. So that's a shift we're starting to see right now, because that's a lot of advisors love to play PM. They love to play
Yeah, of
portfolio managers.
course. It's a
I
special
I
sauce for a lot of practices.
Right. I will tell you though something that we've seen out there, and it's super important for those portfolio managers out there. A lot of the portfolio managers will say something to the effect of, um, the way nobody manages money the way I manage
Right,
money.
right,
Right.
right.
I'm the greatest PM in the history of mankind,
Yeah,
which
we
is
beat
great.
the S&P 500 for 10 years in a row.
Right. So, and we actually have a couple of firms now that would totally value that, that would love that. But for the most part, guys, for 95% of our buyers, they don't care. Because what they're saying is, how much time are you spending building portfolios, managing portfolios, et cetera?
Right.
What if you just gave that over to us, trading, et cetera, rebalancing? And oh, by the way, you took that extra time and you spent that growing in terms of getting new clients and servicing existing clients, et cetera. And so this is the mentality and part of running it like a business versus running it like a financial advisor.
Yeah, I just and I would encourage people to think about this. I listen, there isn't an advisor that Deej and I don't sit down with who doesn't really love their brand. Of course it is. It's your baby. You built the brand. But in the end, I know you're thinking that your clients are going to really care if they don't see that brand every day. And the truth is they really won't.
Yeah, but
Um,
but what's funny about that is that we do an input short when we bring on a new client, we do a wish list. And one of the questions is, do you want to keep your brand? It's like 40, 50 questions we have. And the answers are must have, deal killer, nice to have, or you don't care. So, and that helps us narrow our 103 firms down to the top 5 to 7 based on us playing Tinder and
right.
Bumble and
But isn't the
matchmaking, right?
truth isn't the truth that more firms that used to be aggregators have moved to be integrators now?
I think that's the trend. I think in the next couple of years, you're going to see more and more folks be an integrator that give you flexibility in terms of the money management.
Yeah. Yeah, I think
Now, by
so.
the way, one of the benefits of being an integrator is the brand. Now, some of the both integrators and aggregators could say you could keep your brand, Jenker Incorporated. You could co-brand Jenker, powered by Bain Capital, right?
Right.
Or you take on their brand. Um, one of the reasons that people buyers believe having their brand somehow connected to you or just being their brand is simply name recognition. So if you're in a town in, I don't know, South Dakota, right? And you've had Janker Incorporated forever and ever and ever, by bringing in a big brand name that does brand name advertising, et cetera, or co-branding with them, it could be meaningful in terms of marketing for you.
Well, I just think it's another headline for everyone to be thinking about going here into 2026. We're probably going to see a lot more of it. Any other any other big headlines, DJ, you think as we wrap up here? I mean, I can't believe how much fast 45 minutes blows by every time we do one of these. But I think you see in this monetized advisor, we're not focused on coaching you on how to grow your business. We're not here to talk about marketing funnels. We're here to talk to you about where the industry is as the leaders in the industry, about advisors that are selling the practices. And when you use JPTD, we show you how to basically get the best deal for your business.
Exactly. I
Do
would
we
say a
work?
couple. Just I'll say three things. One of our partners, Peter Velarde, is the king of three. So here are the big three things that I think. I think number one is, guys, you never ever ever want to represent yourself. Okay. Um, no professional athlete represents themselves. No Hollywood
Totally.
actor represents themselves. No CEO usually represents themselves. C-suite executive represents themselves, because you don't know what you don't know. Um, and we've negotiated deals that are just like unheard of. Number two is that we talked about it earlier. Um, the buyers are looking for certain things. So while size matters in the multiple itself, there are a zillion other little things that they look at in evaluating you. Okay, and some of them are objective, like how do you run the business, right? but some of them are subjective. And don't discount what I call the likability factor.
Sure.
They gotta like you. We had one client one time. I said, "Dude, you've got to smile. you, you just you
Show some teeth, baby.
show some teeth, and we can help you coach you up because if you say the wrong thing in one of these Zoom meetings that we're on with you, it could cost you millions of dollars. And millions. And then the last thing, guys, and quite frankly, is probably the most important thing. And Teddy, you talked about this earlier. I have zero idea how long this is going to last.
That's
You
right.
know, and so if you say to yourself, "I'm going to wait 5 or 10 years, grow this thing," great. If you remember when we first started this, we thought our average age client would be like mid to late 60s, right? On the
Right.
verge of retirement. 99% of all of our clients, all of our deals have been sell and stay. Our average age client is 48 years old. So people are like, why would a 48-year-old sell and stick around for a long time? And maybe that's a whole other conversation that we could have on another podcast, Jenker. But they're smart because they realize that the time that we're in right now is very, very special to be a financial advisor. And like I said, everything's aligning. The multiples, the tax laws, the earnout time, the war. At some point in time, there's going to be a consolidation. You're already starting to see it in the industry. And
Right.
when you get less and less buyers, it's harder to negotiate.
Well, I love it. Well, listen, folks, every week we bring you the Monetized Advisor. This is the podcast and show that you should tune into to learn more about what's happening with deal flow, valuations, what we see in the industry for people that are buying practices and selling practices, and everything in between. You're going to hear from real live advisors in a couple of weeks. We've got on Matt Jarvis, who's somebody we represented and obviously a known figure in this industry, and many other people. You'll hear from some of our other partners who look at the business slightly different and how we go about dealing with clients and what they see in the industry. But this is the number one place to tune into, not about what's happening with Roth IRAs, not about whether you should use Wealthbox or Redtail or Salesforce, one of those CRM systems. But when you are thinking about growing your business, scaling it, and then one day selling it, this is going to be the ultimate show to listen to. So hopefully you got a good idea about what happened in 2025. You've got our State of the Union for 2026. If you're interested in having a conversation, you should go to www.sellyouraum.com, sellyouraum.com. And like Deej mentioned, even if you're going to try to kick the tires, I mean, you can only know what your business is worth, not by what FP Transitions or SRG tells you, but you can only know by taking the thing to market. The market is the ultimate decider of what the business is worth. So, Deej, good to see you to kick off the new year here. You're going to see a lot more of these two faces on here on the podcast. Hopefully, you can catch us at one of the conferences this year. Miami will be down there for Future Proof. Let's definitely hook up for a cocktail, a beer, whatever it may be, and talk more about it. But thanks for tuning in to our inaugural broadcast today. And we look forward to talking to more right here on the Monetized Advisor.
Happy holidays, everybody. Great job.